Welcome back, my friends, to the show that never ends. Insurance, starring me, Dr. E. So, let's finish up this section on life insurance and look at Chapter 13, which covers some topics that you need to be aware of as you shop for life insurance. Okay. We all use cost as a basis to make decisions, and so this definitely applies to life insurance. What is the cost of life insurance? How do we measure the cost of life insurance? So the cost of a life insurance policy is the difference between what you pay into the insurance company and what you get back from the insurance company. And as you know, what you pay into the insurance company is a premium. What you get back from the insurance company depends on the nature of the contract, the type of policy that you might be buying. So if you buy a non-participating term policy, the only thing you will ever get back from the insurance company is the death benefit that your beneficiary will get when you die. Now, the policy could lapse or terminate before you die. Let's say you have a 30-year policy, term policy. The 30 years is up. You're still around. What do you get back? Nothing. What does that mean? That means the cost of the insurance is what you paid in. It's your premium. But if you buy a whole life policy, including your universal life, you might get dividends back, you will have a cash value. So then your chore, your objective, is to determine what the cost of the coverage, the death benefit, is. Okay? So we're going to look at it three ways to do this. All right. So when determining the cost of life insurance, four major factors have to be considered. You have to look at four things to determine your costs. First, what are your annual premiums? Second, what are the cash values in the policy? Third, what dividends are paid? And then fourth, you have to take time value of money into consideration if you want to do an accurate analysis or assessment of what you are paying for that death benefit. Okay, so this first method of determining cost is called the traditional net cost method, and I want to warn you that it does not include time value of money. So this analysis, this approach is commonly used, but it is flawed, not a good method. Okay, so what you do is you accumulate the premiums, and then you subtract out the cash value and the death benefit, the expected dividends, to determine your cost per year of having the death benefit coverage. Okay, so this method does not consider time value of money. Let's look at an example. You have a policy, it has a $10,000 face value, okay, that's the death benefit, and it pays a $29.95 yearly dividend. Let's say 30 bucks, okay? The premium is $132.10. Keep in mind the annual premium is paid up front. The annual dividend is received at the end of the year, okay? All right, the cash value at the end of 20 years is $2,294, and the book does not give an explanation of how they came up with this cash value. And it's important to understand how they came up with the cash value. Of course, this cash value at the end of 20 years is the difference between what you actually paid for your coverage and what was contributed into your accumulation account. Okay? But anyway, so what they're saying is you pay in $132.10, you get back $30 and each year, and also at the end of 20 years, you get back $2,294. That's your surrender value. All right. So here's your total premiums for 20 years, $2,642. Here's your total dividends. So this is $132.10 times 20. This is $29.95 times 20. Okay? So you subtract the dividends from the premium, and then you subtract the cash value from the total premium, and what you get is you actually paid in a negative $251. In other words, they paid you back $251 more than what you paid in, okay? Which is per $1,000 of death benefit, that's minus $12.55 per thousand. Or, I'm sorry, this is the per year, the annual cost. It's negative. It doesn't consider time value of money, okay? And if you divide the $12.55 by the $10,000 divided by 1,000, which is 10, then you get $1.26 minus $1.26 is the cost per thousand of coverage, okay? But this is a flawed analysis. A lot of people look at it this way, but it's a flawed analysis. All right. Now you have the interest-adjusted cost method, and this is a much more accurate way of calculating your actual cost of insurance. It does consider time value of money. All right. So there are two forms of it, and the first is the surrender cost index. And this is useful if the owner expects to surrender the policy at some point in time, which most owners of whole life policies do. That's why you have the policy to begin with. I don't know why there are two methods. There's a second method we're going to look at here, but let's focus on surrender cost index. All right, the distinguishing step is to subtract the surrender value from the cost of insurance to compute the net cost, which we did. The distinguishing step is to use the time value of money. All right, so what do we have? We have annual premiums that are paid annuity due up front of $132.10. So there are 20 of these. This is done as an annuity due. This is a future value at 5%, accumulated at 5%. Okay? This is assuming you could earn 5% on your premium. Okay? Then you subtract out the present value, or I'm sorry, the future value of the dividends. Okay? So the dividends are paid. The first dividend is paid at the end of the year. So this is an ordinary annuity. Okay? $29.95, 20 of them, accumulated at 5% interest, is worth $990. So you take the total paid in less than $990, and you come up with, and then you subtract out your death benefit. Your accumulated value, your surrender value. Okay, so you take your total value paid in that's accumulated at 5%, your dividends that accumulate at 5%, and your surrender value, and this is your actual cost. Notice this is positive because it has the time value money considered. Who gets this time value money? The difference between this and the negative balance that was recorded under the traditional cost method, and that is the insurance company. They earn the float on your money. Okay, so then you divide the $1,302, which is the total cost over 20 years, by 20, and you get $37.50 per year is the actual cost of the insurance coverage. Okay? Then you divide that by 10 because you have a face value of $10,000. So you divide 10,000 by 1,000 and you get 10. And you divide $37.50 by 10 and you get $3.75. What is that? That is the cost per $1,000 of death benefit that is being paid. And this is something that you can compare different policies with. What is the actual cost per thousand? Now keep in mind that when you do this, the only thing you're comparing is the death benefit. Okay? The cost of the coverage per thousand. That's what you're doing here. There are other potential terms or benefits of your policies are not being compared, it's just cost alone. Okay, so that is the surrender cost index, and then you have the net payment cost index, and you use this if you do not plan to ever surrender your policy. Okay? So you don't subtract out the surrender cost. Okay? Now, one thing that you must do here is that the face value is of the policies has to be the same when you do your comparison. Okay? So, at least that was what was in the book, but then again, I don't think that's actually true because you're doing a cost per thousand. So that's really what you're comparing is the cost per thousand. So whether it's 50,000 or $1 million, it doesn't matter. How much are you paying for each $1,000 of death benefit? Okay, so you do the same analysis. Your premium accumulates at 5%. Your dividends accumulate at 5%. You subtract your dividends out, and you get your total cost. And you divide your total cost by 20 years, and you get your annual cost. And then you divide your annual cost by 10, and you get your annual cost per $1,000 of coverage. Okay? Now, of the three methods that we've talked about in the last couple of minutes, I prefer the surrender cost method, right here, because at the end of the 20 years, you're probably going to surrender the cash value of your policy. So the question is, how much are you paying to have a death benefit for the 20 years? Now, there are other terms involved. If one policy gives you a higher credited interest, then that's going to be something you have to take into consideration as you decide what the cost is of your policy. The bottom line is you're looking at this number. Okay? You're comparing policies and you're saying, how much is it going to cost me each year, okay, per $1,000 of coverage? And of course, what you're looking for is a combination of the lowest cost and the best terms, the best provisions that the policy has to offer. It's not just about cost. It's also about different terms that the policy has to offer. For example, the credited interest. But this is an important basis of comparison. All right, how much does it cost you for your death benefit each year per $1,000 of coverage? All right. All right, so interest-adjusted cost indexes should be used to compare policies across insurers. So what this is saying is, this is the way to determine cost. Okay? You will find that there's a wide variation in costs across insurers. In other words, it pays to shop around, folks. Okay? Most consumers just use premiums for comparisons, and that is not accurate. Okay? That is not accurate. The accurate way to compare is to do the surrender cost index. All right? So here's some advice for shoppers. First, focus on individual policies, not on insurance companies. Obviously, all your insurance companies that you are considering, you need to do a financial review. Look at the AM Best ratings. Make sure the company is solid financially, okay? But don't assume that just because an insurance company, it might offer you one type of policy that is best for you, but then you start considering, let's say it's a term policy for 20 years, but then you start thinking about a universal policy. You have to look across insurance companies to see on a policy-by-policy basis who offers you the best deal, okay? All right. When you are comparing policies, make sure that the terms are the same for the policies, okay? It's common sense. You don't want to go just based on cost. You look at other terms, okay? be very careful when you are comparing a new policy, considering replacing an old policy with a new policy. Okay? The cost indexes are supposed to be for new policies only, because there are other considerations if you're thinking about replacing a policy. Replacing a policy can be a dangerous thing to do. Okay? And here's why. You've got to go back through a health review. So if your policy, if your health and age have changed since you took out your original policy, before you cancel that policy, you better do your homework and make sure that the new policy will compare well with the old policy after your age and health are taken into consideration. Remember, with the new policy, you've got the incontestable period that you're going to have to go through again. And you have the suicide clause that you're going to have to go through again. And you have all the commissions that are going to impact, if it's a whole life policy, then you're going to pay, out of your premiums, you're going to pay the commissions all over again. So be very careful before you replace a policy. That's not to say that it never makes sense to replace a policy. Sometimes it does, but you must remember these issues as you go about determining whether you should replace a policy. Okay? All right, moving on. So in the table below, the lower the number, the lower the cost. So this is going to be an illustration of the cost of insurance. Okay? And please note in the table that the actual cost of the insurance is higher than what was illustrated by the insurance companies. And the reason is interest rates went down and dividends paid went down as well, because the insurance companies did not earn as much as they thought they would on their bonds because interest rates went down. All right, so what you see is 20-year performance for a $250,000 policy, okay? Whole life policy. And so this goes, it was issued 12/31/1990, and it runs through 12/31/2010. So it's a 20-year policy. Here are the annual premiums for the policies. Okay? Annual premiums. So that's easy to compare. You look at this and you go, okay, it looks like this one is the lowest. Okay? But then you have your surrender cost index. Okay? And these numbers are negative because they don't take in the time value of money. Okay? They do take in the dividends, and they take in the payback of the surrender cost, of the surrender value. And this is per thousand. Okay? But it doesn't consider time value of money. This was what was illustrated. This is what the actual cost was per thousand. Okay? So what are you looking for here? You're looking for the cheapest one, and it's going to be this one. And it still is a Savings Bank Life of Massachusetts. Okay? This is the net payment index that does not consider the surrender value. And if you look at this one, this policy is the cheapest, $8.20 per thousand, New York Life. Again, I like looking at the surrender cost index because you're going to surrender the policy to pull your cash value out, hopefully. Now, you know, if your goal is just to accumulate the money and not pull it out and wait for the death benefit to be paid, because remember, when you surrender the cost, the death benefit goes away. If you surrender the policy, the death benefit goes away. And the death benefit might be a whole lot larger than the accumulated value of the policy, and you might want to leave it in effect. And if that's going to be the case, then you would look at the net payment index, and again, where do we find that lowest number? It looks like $10.08, and that's going to, oh, Savings Bank of Massachusetts once again. So they must pay, Savings Bank must pay a really nice surrender value, a nice credited interest on that surrender value on that policy. So this is going to be the cheapest policy out there, but it's not fair simply to look at premiums. You have to look at the surrender cost, and you have to look at the net payment cost to determine how they stack up. Okay? And what's going to be the most expensive? It looks like on a surrender cost basis, the most expensive policy per thousand is Guardian Life, and Guardian Life is going to be the most expensive on a net payment. So you're going to probably stay away from the Guardian Life, okay? And you know, when you look through, you can see you're probably going to stay away from these $4 type costs, and you're going to be looking more at these $2.50 to $3 type costs. Okay. All right. So you'd have to do some research into Savings Bank Life of Massachusetts, because boy, it sure looks good. Got to make sure that this is a sound company before we make our choice. Okay. All right. We're going to end this clip, this section, by going over the Life Insurance Policy Illustration Model Act. So the National Association of Insurance Commissioners puts out model legislation. They really want state legislatures around the country to adopt laws, insurance laws that are very, very similar, so that the public is not confused regarding regulation. Okay? And so this is an act, a law, that focuses on how insurance companies illustrate financial projections about cost and values to customers. All right. Again, the goal, reduce misunderstanding of policy values and reduce deceptive practices by agents. All right. So the first part of the Act focuses on a summary that describes the policy. This is a narrative text that goes in. So the client has to understand how they're being rated. And that's really important, because the rating will determine the premium cost. Okay? So the death benefits explained, the dividend options are explained, any possible riders are explained to the customer. Any elements of the policy that are not guaranteed have to be identified. Okay? If the insurance company is making a projection and it is not a guarantee, then the customer must be told that. Okay? Taxes are discussed. Key definitions in the contract are discussed. And then interest-adjusted cost data is explained. Okay. Then you have a numeric summary. So first you have some explanations in writing or in text form, and then you have a table. The table shows the premium. It shows the value of the accumulation account. This is your surrender value account. This is your cash value account. This is your surrender value account. And you know the difference between this